Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a video update on Friday, December 6, 2024. This morning's jobs report for November was a mixed bag. On the one hand, the national employment rate ticked up to 4.2%. On the other hand, the 227,000 new jobs added to the economy last month was more than expected by most analysts. Now, here's a link to that report, and there's some data in there if you're interested to look at. The report also noted both the unemployment rate at 4.2% and the number of unemployed people at 7.1 million changed little in November. Those numbers are higher than a year earlier when the jobless rate was 3.7% and the number of unemployed people was 6.3 million. And that's right here where I got the cursor. I think that's an important paragraph. The fact that the unemployment rate is going up while the number of new jobs opening is increasing even faster suggests the economy is expanding. It is also potentially inflationary, since employers may have to offer more pay to entice workers to fill those vacant positions. So now if you go down to the bottom of this report, and I'm going to move my picture over here so we can see it, but they do talk about the trends in pay and whatnot, and that suspicion is confirmed by the 0.4% rise in wages last month, or 4.8% on an annualized basis. During the past year, wages have increased by 4.0%. That means wages are now rising faster than the Consumer Price Index, which rose 0.2% last month and grew 2.6% over the past 12 months. Nevertheless, a lot of folks on Wall Street are expecting another interest rate cut by the Fed when it meets the week after next. Apparently, so is the bond market. Kind of a little trouble here with the screen. Apologize for that. Here we go. This morning, the yield on the 10-year Treasury note fell below 4.2% after rising above 4.5% 3 weeks ago. So here's, let's take it a year-to-date chart of the yield on the 10-year Treasury note, and you see it peaking back here up around 4.7% in April. Then the big drop is that people feared that we were headed for a recession. And then the big rally in interest rates when it became apparent that a recession wasn't in the cards and that the economy was growing on its own. Nevertheless, the yield on the 10-year Treasury is still lower than it was in April, but definitely considerably higher than where it was just a couple months ago. So at this point, there's a lot of pressure on the Fed to cut interest rates again this month, even though the economy appears to be doing fine without artificial stimulation. Now, I believe Fed Chair Jerome Powell will agree to cut rates again this month, but he will revise the language used during his press conference to reflect a more neutral stance towards future rate cuts. That's not bad news for investors. An economy that requires artificial stimulation, such as ours did in the aftermath of the Great Recession 15 years ago and the outbreak of the coronavirus pandemic 5 years ago, is an economy in trouble. And now that we've gotten out of trouble, there's no sense in inviting danger by overstimulating the economy again. That's why I believe the first quarter of next year will be a messy time in the stock market, especially during the second half of January, when we will start seeing most companies' Q4 and full year results at the same time. The Fed will be issuing its first monetary policy statement for 2025, and the next presidential administration will be taking office. Now, I have no reason to believe that those events will not go as expected. However, an unexpected glitch by any one of them could be enough to unsettle Wall Street. But for now, there's a lot of optimism priced into the stock market. That's this week's update, and I look forward to talking to you in another week. Thank you.